for the afternoon, we are pleased to have Kurt Wolf, our program chair, doing the introductions. For those of you who don't know, Kurt's a partner at Quinn Emanuel, also the creator and host of the legendary Securities podcast. Kurt, thank you very much.
All right. Thank you, everyone, for making it back from lunch on time for our first afternoon panel. This is Financial Reporting and Accounting Fraud, a core enforcement focus. For those of you who were here for the in-house keynote discussion, you will have heard that they focused quite a bit on accounting scandals and some of the pressures that companies face to achieve financial results. So if only by luck, this is a fantastic segue to a wonderful panel to start off our afternoon. This panel will be moderated by Jason Flemmons, who is a Senior Managing Director at Ankura Consulting Group here in Washington, D.C. Jason has over 30 years of experience in forensic accounting, corporate investigations, and technical accounting and audit matters. He previously served as the Deputy Chief Accountant of the SEC's Division of Enforcement. Next to Jason is Brian Kowalski, who is a partner at Latham and Watkins here in Washington, D.C. He's the former global vice chair of the firm's litigation and trial department. Brian represents clients in government and regulatory investigations before the SEC, PCAOB, and other government regulatory agencies. Moving on down the panel, we have David Peavler, who is a partner at Jones Day in Dallas. David served at the SEC for 19 years, including almost 10 years as regional director and head of enforcement for the SEC's Fort Worth office. David has also served as general counsel for a registered broker-dealer and investment advisor, and as in-house disclosure counsel for a major energy company. And last but certainly not least is Erica Williams, who has generously agreed to jump onto the panel last minute today. We couldn't ask for a better guest for this particular panel. You will all know that she is a former chair of the Public Company Accounting Oversight Board, PCAOB. Before that, she was at the SEC for a number of years, where, among other things, she served as Deputy Chief of Staff to 3 SEC chairs. So with that, Jason, take it away.
Great, thanks Kurt. Really great to be here, and thanks to Erica again for joining at the last minute. It was funny because Bruce sent an email to our panel saying that she's going to punch hit, not pinch hit, and then he corrected himself, and I said no, she's going to punch hit. So I'm glad she can join us. So before we kind of started thinking about this panel, one of the first things that I looked into was trying to look at the AAERs, the Accounting and Auditing Enforcement releases that are on the SEC website. There's an index that's published and ostensibly captures all of the accounting actions that have been brought over the last period of time. And what's very stark and telling that I'm sure everybody has probably been seeing, noticing, and feeling is a very precipitous decline in these actions over the years. There were 83 3 years ago. There were 47 last year, and then we've seen 37 actions this last fiscal year, fiscal 25, and of those 37, only 11 were really kind of true accounting cases, because they do capture a lot of CPA reinstatements and some other things that don't really represent true accounting cases. But what's even more stark is that there have been no AERs with any real accounting flavor to them since January 20th. Very stark and very, very interesting statistic. So with that in mind, Brian, I'd love to get kind of your thoughts on why that could be. What's happening? How do we explain that? What does the securities bar, take away from that?
Sure, thanks, Jason. I think there's sort of 2 parts to that question. And one is, looking at since the transition and what we've seen since January 2025 and kind of how that might be explained. And then there's stepping back, the broader question of why there's sort of a cross-administration decline in these numbers, which I think we'll talk about as well. With respect to the first point, obviously at one level, there's been a transition. New chair was not confirmed until April. New enforcement director doesn't arrive until August. And so that's, it's understandable. There's some degree of time before things get up and running. And so that's sort of one potential explanation for what we've seen with respect to this year. I also think, enforcement actions are obviously a lagging indicator. So what's being resolved this year or even closed this year without action is, stuff that started a year ago, 2 years ago, maybe longer. And so the real question, which we'll also talk about later, is there evidence of things in the pipeline right now and active focus on accounting and financial reporting investigations? I mean, I think notwithstanding the numbers that you talked about, Jason, it does seem relatively clear that at least many types of financial reporting and accounting cases should be considered kind of within the back to basics ambit that the new leadership at the SEC has described. And I think, we do see some evidence of that this year, even though there may not be categorized as AAERs. There are some enforcement actions that involve financial reporting and accounting issues that have arisen this year that give us some insight into what may be going on and we'll see going forward. David will discuss that there was a number of sort of disclosure-related cases that have been brought against public companies. They may not involve, they're more about alleged material misstatements related to business activities and things like that, not financial statement items or accounting policies. But I think those are a close cousin of financial reporting and accounting cases, and suggest if there's a willingness to bring those kind of cases against companies, it stands to reason there's still a willingness to bring more typical accounting cases against companies as well under sort of similar theories. There's also been a number of cases brought against individuals in particular that are more traditional accounting and financial reporting type of cases. A number of those cases sort of relate back to prior corporate resolutions from the prior administration. You have certain of the officers from American Renal that settled earlier this year. That dates back to a company settlement that was years ago. You have the former CFO of Acreage, who was allegedly falsified records and lied to auditors about a round-trip transaction. That case was brought, again, relates back to an earlier resolution. And the former CFO and Chief Commercial Officer of Paratium Corp., who were charged with recognizing revenue on non-binding purchase orders from customers. And it's not obviously particularly surprising to see cases brought against individuals in these contexts, particularly given what we've heard from the new leadership at the SEC. But all these cases sort of relate to earlier investigations and earlier resolutions with the companies. And so we'll sort of see what that means going forward, whether the same kind of corporate cases would have been brought under this new leadership. There's also a number of cases that have been brought against individuals with parallel criminal prosecutions. You have the Paratium case I mentioned involved parallel indictments. The Joe Sandberg Aspiration Partners case, Christine Hunsicker Castle case, all SEC with a parallel criminal case. And the SEC really presents those cases as, in its complaints, as sort of outright fabrication of documents, not cases that involve kind of technical accounting issues, complicated judgment-based things, but just straight up outright documents were fabricated and sales were fabricated. And so, I think the sample size this year is too small to draw any conclusions from that. But a question as we go forward is, are those the kind of sort of outright fraud type cases that'll be the focus, or will there be an appetite to explore a little bit more complicated or nuanced accounting matters over the next couple of years?
Yeah, and Erica, I'd love to hear from your perspective too, because I know we've talked about some of these trends. I mean, what would you attribute what we're seeing to, or what are some other observations you have from what you're seeing?
Sure. So first, thanks for having me. I will say that I came to this conference to just kind of kick back because I'm still on sabbatical, but I'm really pleased to be able to jump in and give my perspective. Look, every administration focuses on accounting fraud and accounting cases, and so it was interesting to see these downward trends, and I don't think it's because people are not interested in bringing these cases. I do think that every enforcement director, and including every chair, has a priority of different things that they want to focus on. Accounting fraud is always on that list. One thing that we should really think about is the broader economic environment, and the market has been going up. And traditionally, when you see crisis, recessions, you see more of these cases. And so, if in fact that does happen, I think that there may be more cases brought. We all know that they're really complex. They take a long time to bring. The SEC has that expertise and is always looking to do that. And when they get, whistleblower complaints in or other information about these cases, they always run them to ground. It's just they're very hard to prove. So I do not think that this trend indicates that this is an area that they're not focused on, or that, it might not change if the economic environment changes. One thing that I think we were looking at a few years ago coming out of the pandemic was, were there going to be a lot of cases involving accounting fraud in those instances? And there was relief provided to a lot of companies through the CARE Act and other things that I think alleviated a lot of that. And so, I think stay tuned, but this is definitely an area of focus no matter who is in charge of the SEC.
Yeah, David, from your perspective, I know you track this area pretty closely, and I know, Brian, some of the cases you were talking about, there is this difference, obviously, between the cases and not just the volume, but the types of cases that were being brought prior to January 20th. And another side note, there was a surge of cases being filed in the last few days, right before January 20th. And that what we're seeing kind of after. Can you give us, shed some light on kind of the types of cases you're seeing and some of the highlights from fiscal year 25?
Yeah, I mean, highlights, it really is a tale of two cities. I mean, you have the pre-administration change and post, and the highlights are very different in those two in some respects. But to the extent it still tells us where we're going, and I think, Eric has hit it on the head, it depends on what is prioritized. Each administration brings in its own priorities, and everyone says accounting fraud is a priority, but in the last administration, a lot of resources were spent on other things, and you only have so many resources. And for labor-intensive, resource-intensive cases like accounting and disclosure fraud, that naturally can pull away. But kind of as I think about the pre-administration change, we saw kind of what we had been seeing, a lot of disclosure-related cases or lack of disclosure cases. One in particular was the American Electric Power case last fall, which was part of a longer tail of cases around bribery in the state of Ohio. So it's kind of a domestic FCPA type case. But that was one looking at how they accounted for these certain payments that allegedly went to the benefit of certain politicians in Ohio. We did see some channel stuffing in the first half of the fiscal year, and something about the veterinary pharmacy industry apparently lends itself, because I think there were two cases in this space. DMK Pharma is one of them, and the idea of you have some veterinarian who you just send all of your stuff through, and he buys lots and lots and lots of your drugs, and you're able to meet your quarterly targets. But since the change, and as we try to now either anticipate what's going to come or advise our clients of where we think things are going, that has really shrunk down. And what we have seen, I think, depending on how you count it, 4, maybe 5 cases that fall into that, into that accounting and initial reporting category, that the SEC reports every year. And those are mostly disclosure cases. There was one case that I think would fall into the falsification of records. That's the Leibowitz case, and it has some other interesting things I think we'll talk about later. But that was a more traditional falsify entries, lie to your auditors. That it would fit in the traditional accounting case. But I think the key feature that runs through all of them is they're all fraud. They're all 10b-5, 17a1 fraud cases. And if I was going to take one message out of what we've seen, it's that some of the non-fraud things we saw in the last administration, and I'm thinking here of cases where the star of the show was your ICFR or your disclosure controls and procedures. I don't think we'll see those. Now, that's not to say we won't see 1782 and 3 cases eventually, because a lot of those can turn on the quality or strength of your evidence. But I don't think we're going to see any of these cases in this space that aren't accompanied by intentional wrongdoing. And that's the one message that I think I would try to convey out of what we've seen so far.
Yeah, and that's consistent. There was actually one case, I can't remember the name, but it was brought earlier this year, just right after January 20th, and it involved typical fake revenue, a fake audit report, pretty elaborate stuff, and for whatever reason did not have an AER label on it. But that goes to your point that it looks like the kinds of cases that will be brought will be kind of the more severe 10B, serious fraud kind of cases. Now,
but just to close, I mean, that is consistent with what Chairman Atkins has been saying all along, is we're going to focus on the main thing, which is fraud, and not so much on foot faults, or I think Ralph Farrar once said, bumping up against the securities laws, which I always like that phrase. I don't know what it means, but I always like that phrase. I think we will not see those in this space.
Yeah. So curious of the panelists too, are these declining trends we're seeing in this space, is that, at least in terms of actions filed, is that consistent with what you're seeing on the ground in this particular area? Are you seeing volumes of things, new things being opened, or things that were brought or opened prior to this current administration that are still active?
Well, I'll take the first crack at this, but we're one law firm, and many people in here, I'm sure, may have different experiences. The answer is yes. There are ongoing accounting and disclosure fraud investigations. Some started before, they were formal ordered under the prior administration. One started after. So it's still an issue that the agency is very interested in. The question that ultimately will have to be answered is, okay, let's say they get to the end of this and they don't find the fraud that they're maybe looking for, what do they do with it? And that's where I think the real open-ended question is. But yes, those cases are still there, and I'm sure many in this room could attest to that.
Well, maybe that's a good segue. I mean, raise your hand, anybody in this room, if you have historically, maybe say over the last 2 or 3 years, worked on an accounting case. Raise your hand. All right. Now raise your hand if you have started or been brought into a new accounting matter since January 20th. Yeah. So it's I know it's a small sample size. We'll ask the same question next year and see if we have more hands raised. But Brian, you were going to say something?
No, I think I agree totally with what David said. I mean, there are things in the pipeline that are coming along. I mean, what is interesting as well is, kind of to the point David made about these things get sorted out at the end, that's after a lot of investigative work, and these cases are can be particularly fact intensive. And so, while there's this overhang of, well, where does this go if there's not intentional fraud or scienter, that doesn't necessarily help when you're doing the paces through significant document productions, witness testimony, meetings with the staff, and those so far, at least in sort of my experience, look a lot like they have always looked. It's just going to be a question of where do we land at the end of that extensive process.
I'm interested in perspectives here. I'm going off script a little bit, but what you just described, that expense, the cost, the time to the client to do all these things, and an agency that at least says, we want to hear from you, we want to understand this case, maybe there's an off-ramp, that does seem to militate in favor of an approach that, get in, get the down and dirty kind of facts, and get in and talk to the staff and say, this is probably where this is going to go, and it's not any place you're really all that interested. I haven't tried that yet in the new administration with that type of case. I don't know if it'll work, but it does seem like at least the environment is shaping up to be good for that kind of conversation.
Yeah. Now, how do you all think that the staff currently is viewing kind of different sources of potential investigations in the accounting arena. I mean, historically, there was kind of a wide range of sources, restatements, self-disclosure by companies, whistleblower program, but specifically say to restatements, if a company had announced an impending restatement, filed a 402(8K, non-reliance on previously issued financials, you could all but guarantee that enforcement would send some sort of inquiry to the company. Do you think that's still the case, or do you think they're going to be more selective on kind of when they surface on a restatement type matter?
Yeah, it's a good question, and again, I think my perspective on this is relatively narrow, relative to the full room. But I think there's still, I think the degree and nature of the outreach might change, right? You could see a sort of softer inquiry, like, hey, can you come down and talk to us about this? Can you provide something to explain what happened? Maybe in some cases, versus immediately getting a formal order and dropping a huge subpoena on somebody related to that, and sort of vetting it a little more on the front end. I think we've seen some indication of that happening. But I think it's obviously fact dependent on what's in that 402. There's lots of different kinds of those, and it depends on what's being communicated.
Yeah.
The only go ahead. Please.
Oh, I was just going to say, we all know that there are fewer staff. So, they have to use their limited resources in a wise way. And restatements have been on the increase over the last 10 years. So, there's just a limited amount of time to run down every restatement. I think you're absolutely right that they may decide to use the before a formal order process to kick the tires a little bit. But with fewer people, you can do fewer things.
Yeah, I don't think you can discount the resource aspect of this. I will say, before I left the staff, it had kind of gotten to the place where if you were waiting around and reacting to an 8K, and you were the enforcement attorney, somebody already has that case open on somewhere in the SEC because of the whistleblower program, because of the pressure to self-report. And so I can remember one case in particular, Austin company, we thought we were right on top. Like that 8K came out at 8 o'clock or whatever, and at 8:05, punching something in to open it, and it's already open in the home office. And so I think from how the staff is looking at it, the importance of those resources, the self-report and the whistleblower have grown. And I do wonder, and I think we may have something on our agenda today to talk about the impact of the whistleblower program maybe pulling back a little bit, or at least this commission taking a different view could impact that. And that could also, in addition to the resources, impact how many times the staff opens something.
Yeah. And do we think the same will hold true for how the staff is going to view internal control disclosures? For example, a company that discloses material weaknesses that has, at least over the past 8 to 12 years, been a source of inquiry by the staff. That the idea being, hey, if there's an internal control problem, maybe that would reveal other issues, other financial reporting problems. Do we think that's going to be a viable and continued starting point for investigations?
You still have staff there who, many of them are long tenured, and they're going to use the same, investigative tactics that they have in the past. So I do think you might have some folks doing that. And one thing that I have been saying is, even if you are not getting more investigations for your clients, this is just an opportunity to shift all of the responsibility to them. In an environment where the regulator is doing less, that puts more pressure on management and the board of directors and your audit committee to find and make sure that there aren't any issues with the internal controls, and that you don't have any, financial reporting issues or fraud going on at your company, because shareholders are still going to be out there bringing cases. So, if there's like a takeaway that I like to leave people with, especially with my former hat that I used to wear, this is not the time to take your foot off the gas internally. It is the time to really double down on your internal controls and to make sure that you're really having thorough internal investigations and really relying on your external auditor to do a great job, because maybe the government isn't going to do as much because they don't have as many resources, but these issues are still arising. I know that all of your clients want to do the right thing.
Yeah, and just to add to that excellent point, This is a topic in particular where I think the involvement of an SEC investigation is often one piece of the overall constellation of challenges a company's facing. So it's not, you have to deal with, getting through your process with your auditors and getting current, making sure your financials are accurate, dealing with shareholder class actions, and all of sort of that array of things that comes up when there's a question about the integrity of financial statements that is going to, I think, always make this a critical issue when it arises, even if certain kinds of cases the SEC decides they're not as interested in or not. A company still has to sort through that, and it could be very, very harrowing.
Yeah, I also do wonder, historically, when a case has been investigated and they may have thought it was going to be fraud, they may even wells it as a fraud, discussions happen, submissions are made, meetings are had, and then ultimately it gets settled to something less than fraud, call it an internal controls and books and records type case. I mean, do we think there's going to be an appetite under kind of the current administration to bring a case like that? I mean, I know we're saying that you may or may not start off an investigation that way, but if the focus is going to be bringing the fraud cases and the true fraud cases, and if ultimately it pans out not to be that way, does that give the securities bar a little more room to talk the staff out of bringing the case at all?
It may be. I mean, it's interesting because a lot of the criticism and that the use of the internal controls provisions has gotten over the last several years is bringing it outside of the accounting context, stretching it to cover other things. That was, the subject of some dissents from Commissioners Peirce and Ueda. It was at issue in the Solar Winds litigation. But of course, what we're talking about right now is sort of the ancestral homeland of the internal controls provision. And so it's still more plainly relevant here at some level. But it's still a good question whether programmatically, if you get to that point, is it more likely the case is just going to be closed without action? Or are we going to just agree that we have different views of the facts and maybe we can land on internal controls, which is sometimes can provide a sort of nice off-ramp for these cases, but certainly no case at all would be better.
Right.
I think you hit it on the head. It's probably going to depend on the nature of the case. If you get to the end of it and there is no misrepresentation that the staff can really put their fingers on, but they still want to bring something because they spent 2 years chasing this case, damn it, and we need something, then I don't think that will survive. But where it is a situation, the evidence, there are different disagreements over evidence, there's weaknesses on both sides, and you're looking for a way to reach a solution that's good for your client, and that the commission or the staff could be comfortable recommending. I think we'll still see those. I think we just don't know yet how that will be received. Will this, at some point, the commission say, we don't want to see it if it's not accompanied by, some fraud and a person who actually did something, as opposed to, we're just going to throw punishment at a company and they'll pay a fine and we'll all forget about it. I don't know that we can say conclusively one way or the other where that's going to go.
Yeah.
Maybe some in here have had declinations already and know that, but I haven't seen it yet.
Let's move to the 102E program at the SEC and the jurisdiction of the SEC to pursue auditors, but also there's the PCAOB that has that jurisdiction as well. We're still seeing the after effects of jarcossy, which David, I'd love for you to kind of refresh the audience here on that issue and kind of what we've seen with some of those previously unsettled, litigated 102Es against auditors.
And this audience clearly does not need a refresher on jarcossy, but as it relates to the 102E, when jarcossy came down, there was I guess it was last summer, there was the speculation, what will this do to your contested 102Es? And the SEC stayed its cases, and then just one day we all woke up and there were 20 some odd, or however many it was, dismissals with a single sentence. We've decided to dismiss these. And the implication was they had concluded, they never said, but they had concluded that jarcossy made it impossible to pursue those matters in that forum in a litigated way. And so that's kind of the ground, and so that's kind of the foundation, but it's still a place that the SEC wants to be active and really needs to be active, and together with PCAOB, because of the important role that auditors play in our financial regulatory system. And so what we've seen, and we can talk about this more, are, I think, experimental efforts by the agency pre and post administration change to find ways to reach that same, that same outcome where it's necessary to stop or prevent someone in an accounting or an auditing role from staying in the industry, or at least not permanently staying in the industry.
Yeah. So Erica, does this mean, with kind of the latest developments with the SEC's 102E program as it pertains to auditors, does that mean there's going to be more of a handoff, if you will, to PCAOB staff to address auditor compliance with professional standards?
I mean, I don't think there was a handoff, and I don't think you're going to see a handoff in the future. Of course, the PCAOB and the SEC have concurrent jurisdiction to bring auditor cases, and they have exercised that over the course of the time that the PCAOB's been in existence. Of course, the PCAOB's auditor cases increased while I was there, and they are still bringing cases. The Jarchesi issue, though, is a question, I think for both regulators that they're grappling with, and each of them are going to continue to grapple with those issues. But to David's point, there have been some ways that the SEC has been trying to sort of test the waters in litigation. But a lot of auditors do believe that it's better to settle and get this behind them than to continue to pursue litigation, which we know takes a long time and can be unpredictable.
Mm-hmm. And what we've seen, some of the efforts that we've seen, filing in district court, number one, because you can do that. But when you get to district court, what is exactly the analog the SEC is going to use for the improper professional conduct, which was the key provision of 102E that allowed the agency to pursue net malpractice, essentially. Not intentional wrongdoing, not participating in the fraud, but malpractice. They don't have a perfect analog in district court for doing that. So what we've seen, some different examples, is charging violations, like aiding and abetting type violations, which is essentially intentional, of the company's failures. We did see one case against a PCAOB registered auditor last year that had turned the other way, knew that its client had falsified the auditor's opinion, put that in public filings, and used that to raise funds. And then that auditor also lied to another auditor. So kind of a classic intentional wrongdoing case, but within that were the citations to the the auditing standards, because it was there were deficiencies in the audit. And the way the SEC approached that was to ask for a specific injunction to prevent that auditor and the audit firm from practicing or appearing before the commission. There were more words than that, but that's the basic summary. What's interesting about that, though, is that case played out when they settled in August. The final judgment didn't include that. It included an obey the law injunction on the other traditional charges. But then the SEC took that injunction and got a follow-on 102E. And so that seemed like a model. Maybe this kind of 102E two-step is maybe the model for going forward, because you get your Seventh Amendment right to jury trial in the district court, and then if you settle or lose that, then you come over here and we exercise our power under 102E. But that, again, I think that's a hole that they're experimenting to try to fill.
Yeah.
And it's interesting because I don't know that this is a approach that the current SEC would pursue, but there is sort of an interesting question, I think, about, Jarchesi, obviously fraud claims seeking civil penalties looks more like traditional common law fraud that gives you the right to the jury trial. Is there an analysis where someone would say, well, maybe failure to meet professional standards with the remedy being suspension is sort of a different type of case and it should be decided differently in Jarchesi? I don't know the answer to that. And I'll keep my powder dry on what position I take. But
I mean, the SEC seemed to think
right,
so.
right.
So, I mean, we do know that somebody inside the agency looked at that hard.
Yeah.
So absent that predicate injunction against an auditor that would kind of then lead down the path of a follow-on, or if it's just a pure auditor investigation, non-compliance with professional standards, what leverage, I mean, does the SEC have, or is there really incentive for the audit firm to just ride it out further in the process, knowing that the SEC is not going to file a litigated 102E? Is there a risk then that it would just get referred over to the PCAOB? I mean, what's the answer there?
I mean, in all of these cases, usually the PCAOB and the SEC are talking. So, they come up with a coordinated effort as to not duplicate efforts. And the PCAOB, at least since I've left, have continued to bring these cases. There's, of course, litigation out there related to this issue that started when I was there. And some people may want to see how that plays out. Again, that takes a long time, and it remains to be seen how it will play out. So there are still a lot of settlements that are coming across the pipe.
Yeah. And Erica, I'd love to also, having you here with 1 hour notice, if that, to be able to sit on the panel. But I would love just to get your perspectives on just high-level kind of trends at the PCAOB from an enforcement perspective, the types and complexion of cases that you were observing, especially while you were there, just the kinds of things you were seeing in the industry that would be helpful, to hear from you on that.
I mean, look, I think that, again, enforcement cases take a long time. And so what you're seeing now is the fruit of cases that started before, months before, and in many years before. One thing that I often say is that, the statute of limitations on many of these cases is longer than the political wins. And so, it's sort of to folks' peril just be looking 3-4 years down the line. Because you never know when an investigation could be started, and it could start 4 or 5 years from now, and you just don't know. So I think that, and all of the folks who are in enforcement at the PCAOB and the SEC, it's in their nature to want to bring big cases. They're going to continue to push. It doesn't matter, and I was, like you all, on the staff as chairs came in and went. So they're going to try to push. It does, I think, it is going to have an impact as to whether certain things can get through the commission. But in general, they're going to continue to do the work that they have always done. And I think, from seeing some of the hands raised here, you still see the staff pushing when they think that there's wrongdoing, when they're getting whistleblower complaints, when there are restatements and things like that. So in a lot of ways, it's sort of, par for the course, but also don't be short-sighted. Think about years down the line.
One other topic that came up on the prior discussion with McLucas and Dan Gallagher. So was it this topic about the potential change in quarterly reporting, going from quarters to semi-annual, and they laid out exactly what's been out there in the industry on the reasons, pros and cons, for that. I'd love to get this panel's perspectives on that. I mean, we know that foreign private issuers are only required to file semi-annually in Form 6K. But what does that kind of mean, do we think, for not just public companies, but perhaps for the enforcement program?
Well, I'm not a policymaker, so just as a defense lawyer, I think the fewer potentially actionable statements our clients have to make, the better. But look, I think there's obviously give in in 13A. There's room to change the way the current structure is. We could see, one quarterly report, or at 6 months with people doing earnings releases and earnings calls at the end of quarters. There's a variety of things that perhaps the market will want to see from companies to make sure that investors feel like they have the information they need, and I think that could all play out and be interesting. At the end of the day, whether it's in that single semi-annual report, or whether we're out there still talking, the companies are still out there talking to investors about interim performance, even in just like an earnings call. All of that stuff is has the potential to generate these kind of cases. And so I think it's still, it might limit the number of SEC filings that could potentially be at issue, but the fundamental issue of materially accurately communicating information to the market is still there, and it's just going to take on potentially a different form if that's the route we go. David?
I mean, so I think the last panel hit it on the head in that this regime works elsewhere. It works for foreign private issuers. So I don't think it's a question of like suddenly the world's going to go crazy that we aren't reporting every quarter. I don't know if all the benefits, in terms of savings and things like that, are going to materialize, because companies are still going to monitor their performance, their management, and is still going to want to know what they're doing month and month, and whether that's every month or quarter or however you block it, they're still going to be looking at it. And investors, at least institutional investors, are still going to want to know things. But and I would never try to suggest that I know what Chairman Atkins is thinking on this, but he does believe in market solutions. And I think this is one of those places where the market, in a lot of ways, will dictate the right cadence for companies and investors, calling for or demanding information, whether it's through 8K or some other format, will provide the market what it wants, not what the SEC tells the market it should receive. But it does, the downside, and they touched on this too, I can see like 2 or 3 different spots. One, potential for insider trading seems to go up when you're not purging yourself of all this non-public information every 3 months. Reg FD violations, because you've got investors talking to your CEO doesn't follow the rules, boom, you've violated Reg FD. And I can see shareholder class actions coming up where a company has something happen in February that doesn't get disclosed until June, or I guess now, August, by the time they file it, that they should have disclosed it earlier. Kind of like this, well, we're going to now play games about the different parts of Form 8K. So that's, I think, some risk. And then ultimately, the thing the commission will have to decide is what is the impact on the retail shareholder? Because all these other people have access in a lot of ways to information, but the retail shareholder, who isn't reading quarterly filings, admittedly, is not going to get information until every 6 months. And whether that's good or not enough, I guess, is the policy decision the commission will have to make.
Yeah. And Eric, I know you've been following this issue too.
I have. I completely agree with what Brian and David said. I do think that, retail investors right now don't feel necessarily they're getting as much information as they need, or the information that they're getting, it's not in an easily digestible form. At the same time, there is a thought that if a company is not just focused on the quarterly reporting, there may be some long-term initiatives that could be beneficial to the overall company's value that they may be able to implement. So I know that there's a school of thought on that. I do ultimately think the market is going to, if they decide to do this, dictate itself. I think the prior panel mentioned, well, what about your new companies who aren't as well established in their financial reporting and internal controls? And that, I think, may be a concern because people just don't have a lot of information about them. But your more established companies are, to David's point, going to find a way to provide information to the market probably more frequently than semi-annually.
Yeah. I also think from an enforcement perspective, if we did migrate to a semi-annual reporting, think about those cases like the valuation cases or the goodwill impairment cases where there's an email that's sent on the last day of the month and there's some question about the value, and that becomes the exhibit 1 to an SEC investigation on, see, you were on notice and you should have known that your valuation was wrong. What if you had an extra three months, right, for that actually to bake more? Would that really, be a case, or would there be, evidence that would have come up later that would have offset that? So I think having those extended time periods could change how those matters are viewed as well. Right. Well, look, I think we're about out of time. I want to thank my panelists and especially Erica Williams for joining at the last minute.
Thank you for having me.
Thank you.